Can Taxes and Bonds Finance Government Spending? By Stephanie Bell. Section 5. The Nuances of Reserve Accounting. The purpose of this section is twofold. First, the commonly held belief that taxes and bonds are used to finance government spending will be examined. First, the question will be addressed intuitively, drawing on the reserve effects analyzed in sections 2 through 4. Second, for those who remain unconvinced by the intuitive analysis, the question as to whether the proceeds from taxes and bond sales are even capable of financing government spending will be considered. The argument requires an application of basic accounting principles to an analysis of reserve accounting in order to determine whether revenues from taxation and the sale of bonds are even capable of financing government spending. Both questions seems absurd. There is surely no doubt that the proceeds from taxation and bond sales are deposited into accounts held by the U.S. Treasury, either with commercial banks or at the Federal Reserve, and that the government spends by writing checks on Treasury accounts at reserve banks. Moreover, since funds are transferred from tax and loan accounts to the Treasury's account at the Fed in order to cover anticipated shortfalls in these accounts, it certainly looks as though the government uses these proceeds to finance its spending. This apparent interdependence is, undoubtedly, the basis for the treatment of taxation and bond sales as financing operations. But is the coordination of taxation and bond sales with deficit spending due to necessity, or does it mask a more pragmatic operation? Let us consider the argument that the coordination owes itself to necessity, that is, that the government needs to tax or borrow from the private sector in order to finance its spending. The question can be approached pragmatically, using the following important conclusions drawn in sections 2 through 4. 1. The payment of taxes and the purchase of bonds by the private sector drain reserves from the banking system as the proceeds are placed into the Treasury's account at the Federal Reserve. 2. Government spending causes a system-wide increase in aggregate bank reserves. 3. Changes in the total level of bank reserves cause changes in the federal funds and other short-term interest rates. 4. The Treasury manages its closing balance in reserve accounts by coordinating its spending, taxing, and bond sales. 5. Barring self-imposed constraints, the Treasury could manufacture all of its spending balances by selling bonds directly to the Federal Reserve. But why should the government need to take from the private sector the money, currency, and/or bank reserves that it alone is capable of creating? It seems reasonable to suggest that it is not money but bridges, armies, satellites, etc. that the government wants, and that it acquires them by encouraging the population to provide them in exchange for government money. That is, it cannot be the government but the public citizens who need the money in order to settle their tax liabilities to the state. Indeed, the entire process of taxing and spending must, as a matter of logic, have begun with the government first creating and spending new government money. However, how, after all, could a population settle its tax liabilities using the government's money, high-powered money, before the government had made its money available? In other words, the government's purchase of goods and services using newly created money must first have supplied the citizens with the means with which to pay taxes. Thus, taxes can be conceived as the means by which the government directs real resources from private to public domain. If this theory is accepted, taxes are used to create a demand for the government's money, not to finance the government's spending. Similarly, bonds need not be issued in order to allow the government to spend in excess of current taxation. This, again, is because the government can always create its own spendable balance internally on its consolidated balance sheet by offsetting a treasury liability against a Federal Reserve asset, for example, but not necessarily a treasury bond. In the absence of bond sales, deficit spending would result in a net increase in aggregate bank reserves. Bonds, then, are used to coordinate deficit spending, draining what would otherwise become excess reserves. They provide the private sector with an interest-earning alternative to non-interest-bearing government currency and allow the government to spend in excess of taxation while maintaining positive overnight lending rates. Thus, an intuitive analysis of Treasury operations suggests a practical motivation for the coordination of taxation and bond sales with government spending. Specifically, because of the reserve effects of taxing spending and selling bonds, the government chooses to coordinate these operations in order to mitigate the impact on banks' reserve positions and, hence, on short-term interest rates. This interdependence, then, is not de facto evidence of a financing role for taxes and bonds. On the contrary, taxes can be viewed as a means of creating a demand for government's money, high-powered money, HPM. Bonds, which are used to prevent deficit spending from flooding the system with excess reserves, allow the maintenance of positive overnight lending rates. Neither taxes nor bond sales, therefore, need be viewed as a financing operation. Many readers will undoubtedly remain unconvinced, based on the intuitive analysis just presented, that the treatment of taxation and bond sales as financing operations should be discontinued. Fortunately, there is another, more powerful method by which to argue that taxation and bond sales should not be considered financing operations. The argument is a technical one and requires an understanding that Federal Reserve notes and reserves are booked as liabilities on the Fed's balance sheet, and that these liabilities are discharged, when they are offered in payment to the state. It must also be recognized that when currency or reserves return to the state, the liabilities of the state are reduced and high-powered money is destroyed. The destruction of these promises is no different from the private destruction of a promise once it has been fulfilled. In other words, when an individual takes out a loan, she issues a promise to a bank. Once she makes good on that promise, that is, repays the loan, she may destroy that loan debt liability by eliminating it from her balance sheet. Likewise, the state, once it fulfills its promise to accept its own money, high-powered money, at state pay offices, can eliminate an equivalent number of these liabilities from its balance sheet. Thus, while bank money, M1, is destroyed when demand deposits are used to pay taxes, the government's money, HPM, high-powered money, is destroyed as the funds are placed into the Treasury's account at the Fed. Viewed this way, it can be convincingly argued that the money collected from taxation and bond sales cannot possibly finance the government's spending. This is because in order to get its hands on the proceeds from taxation and bond sales, the government must destroy the money it has collected. Clearly, government spending cannot be financed by money that is destroyed when received in payment to the state. How, if not by using the money received in payment of taxes and bond sales, does the government finance its spending? Notice that the government writes checks on an account that does not comprise part of the money supply or high-powered money, but that as it does, The funds become part of the money supply, M1, if deposited into checking accounts, M2, if savings accounts, etc., and part of high-powered money. It is therefore apparent that while the payment of taxes destroys an equivalent amount of money, M1 immediately, and high-powered money as the proceeds go into the Treasury's account at the Fed, spending from this account creates an equivalent amount of new money, both bank money and high-powered money. Modern governments then finance all of their spending through the direct creation of new high-powered money.